We welcome and congratulate the new Governor, Dr. Lowe, on his appointment to this very important role.
We've not seen our job as trying to keep inflation always within a very tight, narrow range. We've not been what some have called inflation nutters. We've had a more balanced perspective.
The world and the economy that Reserve Bank Governor Phil Lowe was describing in his first years at the reins of the central bank are very different to the ones we are experiencing today.
The global economy has strengthened. The pessimism that we saw in earlier years has given way to cautious optimism.
Back then, inflation was below the 2 to 3 percentage point range pursued by the bank. There was still boisterous growth from the end of the biggest resources boom in the country's history. Wages growth was low, the housing market was slowing, and rents were sluggish. A lot has happened since then.
The biggest deficit in our nation's history.
600,000 people have been thrown out of work.
We've experienced a global pandemic, the biggest peacetime contraction in the Australian economy in nearly 100 years, and extraordinary monetary and fiscal policy measures. If there's any good news at all to be found here, it's that this decline is not as large as we initially feared.
In his final appearance at the Economics Committee 3 weeks ago, Dr. Lowe outlined the very different state of the post-pandemic economy he will leave to his successor.
The Australian economy is currently experiencing a period of below-trend growth, and this is expected to continue for a while yet. Inflation in Australia peaked late last year at 7.8%. Our central forecast is for CPI inflation to be around 3.25% by the end of next year, and to be back within the 2 to 3% target range by late 2025. We will do what's necessary to achieve that outcome.
From a benign world where the cash rate stayed unchanged at 1.5% for the first 3 years of his term as governor, Phil Lowe would see rates plunge to a previously unimaginable 0.1% during the pandemic, before relentlessly rising from May last year to where they are today, unchanged since June at 4.1%.
Laura Tingle joins me now. Always nice to have you right here in the studio. Of course, relief is the first thing for today. But what does the decision tell us about the state of the economy?
Tells us a few things, Sarah. The Reserve Bank's always obsessed about inflation, but even it admits that it's peaked and is heading down. But I think the interesting signs in the statement from Phil Lowe in his last hurrah is that he's noting the concerns about China, about the Chinese economy. It's still very much focused on talking about inflation and the risks of inflation, like the services sector being a problem.
Where were we up to with the famous lag? We've been talking about it for months, that the lag is so significant in trying to figure out when the effects are going to show in the economy. Where are we up to?
So if you think about it, the Reserve Bank started putting rates up in May last year, and it's usually a 12 to 18 month lag. Right. So we're really just at the beginning of the lag, if you like. And I mean, I was just looking at the figures again today, 0.1% interest rates, which are unbelievable, to 4.1%, so 4 percentage points. For an average household, that's basically $1,000 a month. It's a 50% increase in the cost of their mortgage. I mean, these are staggering numbers. The Reserve Bank's talking about just continuing on, waiting to see what happens. This is the third time they've left the rate since June. They're still talking the tough talk about we might have to put rates up again, all those things, but I think there's sort of those signs of nerves that they're asserting that the economy will be able to continue to grow somewhat slowly. What's the language? A period of below trend growth for a while, but you know, the governor has pointed to a lot of downside risks.
And just before we come to what the national accounts tomorrow are going to tell us, because the thing that people want to know is, what is that risk of a further hike? How is that decision going to get made?
Well, it will be made if inflation is going up again. Now, all the indicators are that that's not happening. And there's so many signs of the economy slowing. I mean, the building sector is going backwards. Wages growth, according to the bank, is not that strong, and it's sort of in line with inflation as long as productivity takes off, you know, she said, laughing hollowly. So
I think we talked about productivity being the water cooler, non-water cooler topic for the rest of the year.
We've been talking about productivity at the water cooler all day, Sarah, as has everybody else. So anyway, I think it's the language of the Reserve Bank is interested in inflation, so the whole statement is targeted at sort of sounding tough on inflation and making sure people know that they're tough. But I think realistically, it's more about the conversation will turn in the next few months to when the bank may start cutting rates.
What about the national accounts tomorrow? What do we expect to see from them?
The national accounts are going to show us a softening economy. There's investment, the consumption, which is something that the Treasurer was pointing to in the Parliament today. Housing consumption is basically half of the economy and it's not going anywhere. So the economy is still going to continue to grow, but the markets are expecting it to be something less than 2% annual growth and about 0.3% for the quarter. So we're now starting to skim right along the bottom of just enough growth to say that we're not in recession, but it's pretty bleak.
What did the Treasurer do with this information today?
Well, it's interesting to sort of compare the sort of emphasis that you have between Phil Lowe and then what Dr. Chalmers said in the House immediately after the announcement, which was, he sort of said, oh, well, there's a bit of inflation going on, but of course people are still hurting. There's a lot of uncertainty about the economy. I think you've got a much more pessimistic tone and a more anxious tone from the government, just making sure that people understand that they understand, that is, the government understands that people are doing it hard and that the economy is, pretty perilous for a lot of people.
We started in the program by saying this was the last decision that the governor's going to hand down. This is a difficult question to ask you when we know we've only got a short amount of time, but what is the legacy that he leaves to Michelle Bullock right now?
Well, I suppose the legacy for her is that he's made the tough decisions. The likelihood of another interest rate hike, there might be one more in the system, but in general, most people think that it's passed. So he's done the hard work on that. I think if you look at Governor Lowe's, time in the job, he has had to go through an extraordinary period of time with the pandemic. He's faced a lot of criticism, and I suppose a lot of the upshot of that is the review of the bank structure. So she's going to be presiding over quite a different Reserve Bank and a quite different running of monetary policy in the future.
Laura Tingle, thank you very much indeed for joining us.
Thanks, Sarah.